Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
So let's look at some strategies so we can avert disaster in the FX market. So we can buy calls for limited risk. We can buy puts. You could do debit spreads or credit spreads. You could do strangles and straddles, iron condors, and butterflies. A lot of strategies here. What I'm recommending is trying to find ways to avert disaster. If you're buying calls, try to obviously limit it to a certain small percentage of your overall portfolio. Think about hedging. That, again, if you're in the U.S., probably a very good time right now. The U.S. dollar has had a tremendous rally to buy some puts to protect your investments. If you're overseas and you see the U.S. dollar, you have a lot of investments here, that, again, may be a great time to buy some put options. Months ago, when the Australian dollar was so strong, the Canadian dollar was so strong, I did travel to Canada trying to urge investors there to buy some CDD call options to hedge their Canadian investments. So it really depends on your own portfolio and what kind of hedge you need. Calls, again, it's the right to purchase the exchange rate. So calls are going to appreciate when the U.S. dollar is rallying. You pay for this the next day. If you're bullish, you can simply buy calls. You can always close out of the position any time prior to expiration, though. Puts, if you think the U.S. dollar is going to sell off, then you could buy a put option. So, again, the U.S. dollar has had an amazing run against the Australian dollar. Many people last night were predicting, the dollar is going to sell off against the Australian dollar. The dollar rallied even today against the Australian dollar. So you need to be careful. Don't be too early. But, again, if you have a strategy, try to stick to it. Understand that you want to have a plan for that strategy. Always trying to avert disaster. Debit spreads, another great way to trade with limited risk. So you can be either bullish or bearish on the dollar. Debit call spread is buying a lower strike, selling the higher strike. So let's just, as an example, the AUX, I could buy the 140 call and sell the 145 call. Let's say I bought that spread for $2. The maximum the spread could be worth is $5. So I could make $3 on the trade. But the most I could lose is that debit. I could actually do the put spread. I could do the 140.35 put spread or many other put spreads. Again, you could go through the similar math. Say the put spread was worth $1.80. How much could I make? Well, about $3.20 then. Credit spreads, I could sell options to try to bring some income into my account. Again, the theme of this presentation is averting disaster in the FX market. So I'm not recommending selling naked options because that could create disaster. Credit spreads. I sell a call, maybe I buy another call. I sell a put because I think the U.S. dollar is going to rally, but I buy another put just to protect myself. So credit call spread, sell the lower, buy a higher, or a credit put spread is going to be the opposite, where I'm selling the higher put, buying the lower put. So why would I trade spreads? Again, to try to avert disaster, try to reduce my volatility risk, try to reduce my time decay risk. Each vertical spread has limited risk, so this is a more moderate approach. So for those of us that want to avert disaster, again, spread trading is great now, but that doesn't mean if you need to hedge some currency, you're probably not going to use, I don't think you would use a spread trade. You would just simply buy a call, number of calls that you need, or number of puts that you need. Great site. It's the Federal Reserve Bank of New York, so you can Google it. I don't have the actual URL here, but every month the Federal Reserve Bank of New York actually posts the volatilities, and you could see, I like to see this because, again, you can go to Live Vol and get the volatility from the options market every day, but I like to see the big banks and what they're quoting on volatility, and you could see that the Euro Vol is just amazingly high. If I go out 1 month, we're looking at about 17 volatility. And that was last week. Now it's more like 19. Japanese yen, about 18 vol. That's now at 21. Swiss franc, that's the symbol. That's their symbol, CHF. Ours is SFC. Vol is about 17. The if we look at the Australian dollar, vol was 24 as of last week. When I looked at it today, it's gone up to 28. So what's amazing is if you see the short term, when you look at 1 month vol is 24. The normal vol, oh, thank you. The URL is www.ny.frb.org. Thank you. You look at the 3-year vol in the Australian, the normalized vol is about 14.8. So right now we're experiencing tremendous spread between the short term and the long term, which means the markets are really nervous about the short term. So think about spread trading because, again, we have vol risk if we're trading short-term options. It's quite possible that vols could actually drop from, let's say, 23, 24, easily down to 15 in the next couple months. But tomorrow, who really knows, as we've seen the market move in tremendous ranges each and every day. Volatility positions can be traded. So what if you felt the dollar was going to make a big move, but you weren't sure which way? Well, you could buy both a call and a put. You can't lose on both of them if it's a straddle, but remember, you're paying 2 premiums. So you have to, in fact, this is sort of the popular strategy now, but be careful. As I said, the volatilities are so elevated that it can be dangerous also. So buying, let's say, the same strike call and put means I have the right to buy the U.S. dollar and I also have the right to sell the U.S. dollar. The most you can lose is what you paid for that straddle. The best case scenario would be, just think if you did the AUX straddle, the 103 straddle, let's say 4 months ago. You bought a 6-month straddle. Well, that would have been basically a home run because you probably paid maybe $4 or $5 for the straddle, maybe 6. And the straddle now, the put is worthless, but the call is now worth $37. So, it's rare that you'd have that kind of move, but we did see a tremendous move. Strangle, buying both a call and a put at different strike price with the same expiration month. Normally the out-of-the-money calls and puts are equidistant from the underlying price. The most an investor can lose when purchasing a strangle is the premium paid. Best case scenario would be for the FX pair to move below the put purchase or far above the call purchase. So we're looking for a tremendous move, and we actually pay less. We get a little bit more leverage. Our probability is even lower. But again, another great strategy for averting disaster is basically buying the straddle, buying the strangle, but we have to recognize that we're paying a lot of option premium and we would be hurt if the market actually quiets down. We could lose all or most of what we paid for that premium. Iron Condor, here's a trade where you're looking for the market not to move that much. So I'm sure many of you have thought about doing the Iron Condor, or some of you have actually got into this where you're selling both an out-of-the-money call spread and an out-of-the-money put spread. Normally, they're going to be somewhat equidistant, so they're going to be pretty close to each other, maybe $5 down, $5 up. The most an investor can lose is the difference between the 2 strike prices. Of course, because I'm going to have the equidistant strike price between, let's say, give an example, $5. Let's say that I take in $2 or $1.50 for that out-of-the-money call and out-of-the-money put aggregated together. If I take in $1.50 and my spread width is $5, I could lose $3.50. But the best case scenario is if it doesn't move too far up or too far down, I could earn that whole premium. So in non-volatile markets, this is a great strategy. Also, for those of us that are trying to avert disaster, but we just really feel comfortable. If you feel comfortable in selling options, this is a great way to trade right now. Even though it hasn't worked that well over the last, let's say, the last 6 or 7 months, depending on the products you're in. Maybe it worked okay in, let's say, CDD. It obviously did not work well in AUX, probably not working in EUI. BPX, not so sure, probably didn't do that well there either. But again, selling an out-of-the-money call, out-of-the-money put, at least that's a more moderate approach. And the most important thing, trying to avert disaster means that I have a hedge. And again, my hedge is that I can only lose a limited amount.
Thank you for listening to our podcast. Please visit www.ise.com/podcasts.